Joining us now is former Vice Chair of the Federal Reserve, Roger Ferguson. Roger, it's great to have you here and good to see you. Clearly, 0% short-term rates is probably incompatible or inappropriate for 7.9% CPI, as well as really sub 4% unemployment. So the market on board with the initiation of some tightening here, rate increases. But how do you think that this threat to growth, the geopolitical setup, is going to feed into next week's debate and the policy outlook?
I think, first, thank you for having me on. Absolutely right that the Fed is clearly going to move by 25 basis points next week. Chairman Powell clearly indicated that. To answer your question, I think what they're going to indicate is they're attuned to inflation, which is clearly far beyond their 2% goal. And at the same time, they're going to have to recognize that the risks, as the chairman said in his testimony, are much higher than had been originally expected. And so while they're going to be moving, I think what they're going to indicate is a lot of prudence about not moving so far and so quickly as to throw this very fragile situation into a recession.
The focus on inflation expectations over the last year or so has been pretty acute. Obviously, the Fed wants to make sure that consumers and businesses don't just essentially extrapolate inflation from now on, and therefore it becomes a much more of a structural problem. Do you think the Fed is taking any comfort in the fact that the markets seem to be okay with pricing in several hikes, and in fact, longer-term market-based inflation expectations have not necessarily really become unanchored yet?
I think they are taking some comfort at that, for sure. Having said that, there are some surveys of CEOs that suggest that inflation expectations are still a little higher than maybe they'd like. And even if you look at the market, what the market is saying is over the next 5 years, inflation probably starting at a 3 handle, 5 years out, perhaps starting at around a 2 handle, but still at 2.5%. And so inflation expectations have not gotten beyond the Fed, but they clearly are still somewhat above the 2% target. So I think it's a bit of a mixed message there. Not panic, but certainly the Fed needs to watch those inflation expectations carefully so that they don't keep continuing to ratchet up.
This dirty word keeps making the rounds and getting priced in here, which is stagflation, the threat of higher inflation with slower economic growth. How dangerous is that, and what can the Fed do about it?
So stagflation is clearly a serious problem, but we should be quite clear. We already have higher inflation. Everyone's marking down their growth expectations. So the issue is, how do you balance? So we still are expecting growth in positive territory. We're not talking about a recession. We are expecting inflation to gradually come down. So the issue here is to differentiate what we're confronting now versus what we confronted in the 1970s, which was a much more virulent type of stagflation. So I'd say right now, Fed still has a great deal of credibility in the market. They're ready to move. And so I think we're going to clearly have somewhat higher inflation we like, somewhat slower growth than we expected. But I would say right now, the Fed still has some room to maneuver. Having said that, getting to a soft landing is always a tricky thing to maneuver.
Yeah, and it seems one of the trickier setups right now that we've had in memory. What about the way the market otherwise is behaving ahead of this meeting? It's been pointed out that there's never been an initial Fed rate hike when the equity volatility index is above 30. We are sitting on about a 12% pullback in U.S. stocks. Credit spreads have widened out a little bit. How sensitive will this Fed be to those signals from financial markets at this point? I
think right now the Fed really should keep a focus on inflation and clearly validate the credibility it has earned and validate the market expectation that it is going to start to raise rates, but in a very, very sensitive and prudent manner. Having said that, I'd say basically markets are basically doing what they're supposed to do. They're reflecting a wide degree of uncertainty. Yes, there's a high degree of volatility, but we're also seeing that there's no absence of liquidity. And as you pointed out earlier, inflation expectations are well contained. So I don't think the market action should constrain the Fed from doing what both it and the market expect, which is, at least the first move out of several to come, I believe.